Does it feel like getting funding for your small business is harder than actually running the business? You're not alone. Most small business owners hit this wall at some point or another. Cash flow gets tight, opportunities come up, and suddenly you need capital fast. But here is the problem. With so many options out there, how do you know which one makes sense for you? In today's video, I'm going to break down 7 common ways to fund your small business. I'll walk you through what each one is, the pros and cons of using it, and what you need to qualify so you can make the best decision for your business. Here's the truth. The right funding can help your business grow, but the wrong funding can keep you stuck or, even worse, put you in a debt spiral. So before you sign that loan agreement or swipe that credit card, you need to understand how these options work and which one fits your situation. First, let's talk about traditional bank loans. Now, these are the loans you get from your local bank or credit union. They usually offer the lowest interest rate and they help build your business credit. The downside is that they're tough to qualify for. The paperwork can be overwhelming, and the approval process is pretty slow. To get approved, you do need strong personal and business credit, at least 2 years in business, and solid financial statements. If your credit is shaky or you're a brand new business, this is probably not going to be your best option. Next, let's move on to SBA loans. Now, these are government backed loans, which means they're lower risk for lenders. The big advantage is that they offer interest rates that are lower than most loans, and they provide longer repayment terms, which means your monthly payment is going to be smaller. The downside is the paperwork is a lot. The approval process is long, and you'll need to personally guarantee the loan. That means if your business can't pay, then you're personally responsible for repaying. To qualify, you do need good credit, a strong business plan, and proof that you can repay the loan. SBA loans are great if you're planning a big expansion and you can wait for a few weeks for your funding. The next option is a business line of credit. Think of this like a credit card, but with a little more flexibility. The great thing about a line of credit is that you only pay interest on what you actually use. You can borrow, pay it back, and borrow again as you need. The downside is interest rates can go up and the lender can revoke the line if your financial situation changes. To qualify, you usually need a decent credit score, some time in business, and a good relationship with your bank. Now, let's talk about business credit cards. Now, these are popular because they're easy to get and convenient for everyday expenses. Approval is usually quick, and many credit cards offer rewards or cash back. But the risk is the interest rate. If you don't pay the balance in full, the interest can add up really fast. There's also the fact that most cards do require a personal guarantee. So that means if your business can't pay, your personal credit is on the line. Most business credit cards require a credit score of around 680 or higher and some steady income. They work best for small, short term purchases that you can pay off pretty quickly. Next on the list are microloans. Now, these are smaller loans, usually under $50,000, and they're offered by nonprofits or community lenders. They're great for startups. They often are more flexible than banks, and some even offer business coaching along with the funding. The downside is the loans amount are limited. So if you need $100,000 or more, this is not the right option. To qualify for a microloan, you usually need a solid business idea and sometimes some collateral. Many programs look for businesses that will have a positive impact on the community. Another option is online lenders. These include companies like Fundbox, OnDeck, or Bluevine. The big advantage here is speed. Approvals can happen in as little as 24 to 48 hours, and the requirements are usually easier than traditional bank loans. The downside is the higher interest rates and sometimes daily or weekly repayment schedules. That can really hurt your cash flow if you're not prepared. Now, to qualify, you usually need consistent revenue, a business bank account, and at least 6 months in business. This is a good choice if you need cash quick and can handle a short term repayment loan. And finally, let's talk about grants and crowdfunding. Grants are amazing because you don't have to pay them back. And crowdfunding allows you to raise money from supporters without taking on debt. The downside is that grants are highly competitive and crowdfunding takes a lot of marketing effort. You need a strong campaign and an audience willing to support your business. Grant eligibility varies, and crowdfunding success depends on your pitch, your story, and how well you can promote it. If you're willing to put in the time and effort, these options can be game changers. So, which is the best option for you? It depends on your needs. If you need money fast, online lenders or a line of credit might be the way to go. If you want lower rates and can wait, an SBA loan or a traditional bank loan might be a better fit. For smaller amounts, a microloan or even a credit card would work if you can pay it off quickly. And if you want free money, start searching for grants or consider launching a crowdfunding campaign. I know this was a lot of information, so I've put together a free resource that lists funding sources, their websites, and key requirements to obtain the funding. Just click the link in the description beneath this video to grab it. And if you found this video helpful, hit like, subscribe, and drop a comment telling me which funding option you would consider for your business.